Hello, everybody, and welcome to another edition of the Richard Haynes Real Estate Show. As always, I'm your host, Richard Haynes, the real estate broker and owner here at Haynes Real Estate, where we're based in the South Bay area of Greater Los Angeles, where we focus on the beach cities, Manhattan Beach, Hermosa Beach, Redondo Beach, and the entire Palos Verdes Peninsula of Palos Verdes Estates, Rolling Hills Estates, Rolling Hills, and Rancho Palos Verdes. We are back on track getting you guys some podcasts on a regular basis. Thanks for hanging in there with us during a busy spring and summer season for our brokerage. We are now able to get back into the swing of things here with the podcast, which I know a lot of you crave when you're in your car or going rucking on walks. We want to try and get you guys some great content in audio format. And for a few of you that like to watch the podcast on YouTube, many thanks to all of you for continuing to listen in, watch us, and of course be patient as we get you guys some great local residential real estate information on these podcasts. Today is September 11th, 2025. We've got three big topics that I want to talk about. I know many of you have gotten used to me always reporting on quarterly numbers or affordability with some anecdotal evidence here or there. Today, I'm trying to drill into a little bit more different type of data that I think all of you will find fascinating. I'm also trying to look at the mortgage market to pull back the curtain for many of you to make decisions as a buyer, when to potentially list with the mortgage market, and of course, if you've bought in the past couple of years, how mortgage changes can affect you and how refinancing could be helpful. And then, of course, I am going to get into some affordability numbers, but more tailored to our specific South Bay cities. So I hope you guys enjoyed this episode. Just to summarize, the three topics we're going to get after today. Topic number one, mortgage rates take a tumble. I'm going to dive into what's happened recently in the mortgage market starting last week. Number two, we're getting into current affordability. The second quarter affordability numbers were released by C.A.R. However, you guys have heard about affordability for years on the podcast and my blog. I'm going to get into more specific numbers as it relates to the beach cities and the Palos Verdes Peninsula. And then lastly, to wrap things up, I'm going to get into cash buyers here in the South Bay. What makes our market so unique is that we are a high-end, expensive luxury market when it comes to the rest of the nation and even much of California. And I'm going to give you some juicy data on cash buyers and why and how that affects our marketplace and makes the South Bay truly unique. So let's get after topic number one. Mortgage interest rates take a tumble. Today is Thursday, but about a week ago, last Friday, mortgage rates saw a huge drop. In fact, it was the largest one-day drop in 11 months, and mortgage interest rates now sit at the lowest levels in the past 11 months. This is a breath of fresh air for our marketplace, because we had interest rates that were chopped last year and everyone was hopeful that mortgage interest rates would fall. And while we had a quick short-term dip in mortgage interest rates, it turned out they popped right back up into those high sixes, even 7% range. And it was really unfortunate for the action in our market. It kept things very unaffordable. We had a sluggish market heading into this year and through the summer, and now everyone's hopeful that interest rates falling can stick, with Federal Reserve interest rates coming and almost guaranteed next week, according to the stock market odds maker. So let's get into what happened exactly. So you guys, for a long time, rates were pushing in the high sixes or sevens. They've steadily been coming down this year, but last Friday we had a huge drop where the average 30-year fixed rate fell to 6.3%. I know that sounds high to many of you, but when you're at the high sixes, pushing 7% on conforming 30-year fixed rates, That's nosebleed levels. 6.3% is amazing. That helps so many buyers afford more properties. That allows sellers to sell into buyers that can now afford their property. And then, of course, anyone who bought the last couple years and has a high 6s or 7% interest rate, there may now be an opportunity to refinance and lower your monthly payment. But here's why rates falling helps the South Bay even more, because interest rates still sound so high. The fact of the matter is many South Bay residents, home buyers and sellers alike, are used to jumbo mortgages. What are jumbo mortgages? They are larger size mortgages above conforming loan limits that banks offer to high net worth borrowers. In the past, when I first got started in the real estate business, I was a mortgage broker in 06, 07, right as the bubble was bursting. And jumbo loans actually cost more to borrow because those buyers were considered more risky. I always never understood that as a rookie 22-year-old mortgage broker, because my jumbo loan clients always had way more assets and cash reserves in the bank, whereas my conforming loan limit borrowers were first-time home buyers eking into their first home, maxing out their debt-to-income ratios. Well, thankfully, or at least thankfully for the South Bay, that is now flipped, where jumbo loan rates typically are better interest rates than conforming loan limits. So when you read in the news that rates are at 6.3%, what it actually means is South Bay buyers and homeowners who are looking to refinance or buy actually have about a half to 0.75% lower than conforming rates. So many clients now are being quoted around 5.5% for 5, 7, or 10-year rates, depending on their banking relationship. So this is huge news for the South Bay market, and something that where we have almost no affordability here, and I'll get to those numbers later. These lower interest rates are going to allow people to buy maybe $100,000 more than they were just last month, or of course just save on payments and maybe be willing to dive in and buy sooner. Now, I don't want to get people too excited, but I do get emails from lenders all the time, and I try to keep up with rates. And with my past life being a mortgage broker, it's easier for me to keep up with rates than others since I did it. But there are credit unions. Typically, I have seen recently that credit unions crush even the big banks and some of the very focused single product banks. Not always, but credit unions, when you move your money over to them, and they give a lot of incentive to new customers. I'm even seeing 5, 7, 10-year rates advertised around 5% for jumbo loans. And if we get any sort of momentum lower over the next couple of weeks, especially if the Fed cuts next week, which is almost a guarantee, then we may see jumbo loan rates with credit unions dip below 5%. That would be amazing, and that would help so many people throughout the South Bay. Number one, home buyers who have been on the fence now may have 6 figures more in buying power or stick to their budget, but have such a lower payment than what they were expecting, they may decide to buy now. What that means for sellers is we had kind of a summer swoon, which is typical for seasonality here. But do buyers get back from their summer vacation, get back into the swing of things in fall, school starting up, and do buyers become more serious and pounce on homes for sellers that couldn't sell over the summer? And then last but not least, for sure, anyone who's bought in the last 2 years and some in the last 3 years, many have 5% or higher rates, really probably 5.5%, 6% or higher rates. If you can link up with a great bank that's offering jumbo loans around 5.5%, or maybe it runs down lower, or if you've been looking into credit unions and you can get a relationship incentive for moving your savings or checking over to a credit union, you may be at 5% or lower for 5, 7, or 10-year ARMs. Of course, these aren't 30-year fixed rates. These aren't perfect comparisons to the 30-year fixed conforming rate. But mostly we see clients doing some sort of middle term arm on the expectation that rates will come down over time, and they feel comfortable with the protections when arms go adjustable if they do change. So you guys, that is the biggest news on the interest rate market. People can refi over the last 2 to 3 years, put more money in their pocket, perhaps buy income properties or invest more in the stock markets, which really helps out the South Bay. Buyers who have just been crushed by South Bay prices now have a little bit more buying power. And sellers, if you didn't sell your home in the late spring and into the summer swoon, now may be the time. And of course, people who are considering selling into 2026, you want to root for rates to continue to come down because buyers will be ready in 2026. That is for sure. So let's go on to topic number 2, affordability. I'm not going to beat a dead horse here because you guys know from all of my blog posts and all of my podcasts, I harp on affordability being the second lowest affordable time in California's history, with the exception of the Great Recession and the housing bubble bursting. The Q2 numbers came out by C.A.R. just a couple of weeks ago. We are slow to report on it, but it is still low affordability. However, things may be changing for the better because that affordability was calculated at rates at being at 6.9%. Hopefully in the third quarter, now that we're at 6.3%, will start to come down from 6.9. And then further as we trend into the fourth quarter, if we're at 6.3 or 6 or 5.9, that is going to really help affordability for the remainder of 2025. Let's hope when we're vacillating around 6 or 17% affordability, that means just 16 or 17% of the California population can afford the medium price California home. If rates do come down by a percentage point, that may pop us up to 20%, which is so much better than the middle teens. And if they come down even more, we may even get to 21 or 22%. And that was the affordability levels in early 22 as rates were starting to rise, as our market was cooling down from being one of the hottest we've ever seen. That to me may be the new norm of affordable markets. We really don't want to stay in the middle teens or lower because eventually a bubble would have to burst. I'm not saying or being an alarmist saying that a bubble is bursting, but if we can get into the low 20s for affordability, that is a wonderful thing in California, knowing how expensive prices are. Now, to give you guys an idea of what it takes to afford a home, specifically in the South Bay. And these are numbers that we kind of pushed out on our Instagram in short form, but not everyone likes to look at our Instagram data numbers because you're on Instagram for fun or humor or other items. I'm going to get into the podcast here of median home prices from a few local cities here in the South Bay and what it would take to buy a home at that median price in that city with 20% down, current interest rates, insurance, taxes, etc. So let's start with the granddaddy of them all, Manhattan Beach, one of our most expensive markets when you take out behind the gates in Rolling Hills. Manhattan Beach, the city median home price is sitting at $3.125 million. If you have 20% down and finance the rest, according to C.A.R's numbers, you would need to earn at least $800,000 to buy the median price home in Manhattan Beach. Let that sink in. You have to make a lot of money to afford 20% down in Manhattan Beach. Now, that doesn't really happen in Manhattan Beach, and there are more affordable options with townhomes and condos, or you can buy a duplex and rent one out. But it just gives you the scale and the idea of income/wealth that you need to buy in one of the South Bay's most priciest cities. Moving on to Hermosa Beach and sticking with the beach, Hermosa's right around a $2.5 million price tag. You need to make about $635,000 to afford Hermosa Beach using that 20% down model. In Redondo, which includes both North and South Redondo, so it's diluted both ways, you need to make $420,000 to afford about the 1.64 median price in Redondo. You would need to make about $420,000 with 20% down. Moving on to the PV Hill, Palos Verdes estate sits at a $2.8 million median home price. You need to make around $720,000. Which is a lot of money. Rancho Palos Verdes at 1.7, 425,000 or so income needed. Rolling Hills Estates, similar to Redondo Beach, around 1.65 million. You need to make around $425,000 to afford Rolling Hills Estates. All in all, you guys, from the beach to the Palos Verdes Peninsula, essentially, if you are buying a home and just putting 20% down and buying the medium-priced home, you need to earn at least $425,000 for the minimum qualifying income. Some lenders may not even approve you at that level if you have higher debt levels or lease payments or student loans or alimony, child support, all the way up to $800,000 for Manhattan Beach. And then, of course, if we were to take Behind the Gates in Rolling Hills, where medium priced quarter to quarter can be $5, $6, or $7 million, you'd probably have to earn around $1.5 million annually with 20% down. So that gives you the scale, you guys, where if you just need to afford the California median priced home around $900,000, you need to make in excess of $200,000. It is still quite unaffordable to buy in California, but the sheer magnitude of income you need to make relative to most people to live and own a home in the South Bay is substantial. So hopefully you guys like those numbers, or at least like the local aspect of the affordability numbers. Now, the third and final part of the podcast is we're getting into some data for some cash buyers. Now, why is the South Bay so unaffordable? Well, there's a lot of people who have bought here and just lived here for the longest time, have tons of equity, or there are wealthy individuals who have started companies and sold them, or they're doctors or attorneys, or people that have just worked really hard, bought in when it was affordable in the 80s and rode the appreciation wave up and are of retirement age. And what I get by that is there are strong and significant cash buyers in the South Bay. So let's get to some data. The reason why we're seeing markets like Austin and Florida, etc., losing value is you have this huge migration out of California and some of the cities to suburban areas, more affordable markets, remote working markets. People rode interest rates to buy homes. And now they're all coming back to the office here in California and other cities, and those markets are now soft. Well, many people in the more affordable markets depend on financing. Here in California, and especially in the South Bay, people don't need to depend on financing. Case in point, let me give you the numbers in Manhattan Beach. In the last quarter of the Manhattan Beach sales, and forgive me if this is quarter or the whole year, I don't have it written down, Q2, excuse me. In the last quarter in Q2, of the 148 sales in Manhattan Beach, nearly 45% of those sales were all cash. Nearly half of the sales in Manhattan Beach were all cash. So why you have to make a boatload of money to put 20% down and buy the medium-priced home in Manhattan Beach? Many buyers, about 50% of them, could afford to buy those properties all cash. If we stick by the beach, Hermosa Beach had 33%. So a third of its 51 sales in Q2 were cash sales. In Redondo Beach, it's even stronger than Hermosa. 90277 South Redondo, 40% of its 70 sales were cash buyers. And surprisingly, if you go to places like Rancho Palos Verdes and PVE, and these aren't the surprising ones, but PVE is at 30%. It's lower than Hermosa, Manhattan, or South Redondo. And Rancho Palos Verdes is even lower at 24%. Who beats out Rancho Palos Verdes with cash buyers? Lomita, many areas of Torrance, and even half of San Pedro beats out Rancho Palos Verdes. So not only do the high-end beach cities and areas like PVE have a high propensity of cash buyers, even our more affordable markets like Torrance, Lomita, and San Pedro have their fair share of all cash buyers. Let's take this even further. What is the typical down payment when you're looking at these cities? Now, the cash buyers affect it, but that's part of the calculation, and there's a lot of finance buyers who are maybe just trying to get the tax deduction or don't want to have capital gains and will finance some of this. The average down payment in Manhattan Beach is around 30%. Palos Verdes, 90274, about 32%. In El Segundo, 30% down. In areas of Torrance, 30%, 29%, 25%, and half of Pedro is putting down 28%. Now, in the more affordable areas in Torrance, you see a 13% because there's probably a lot of FHA loans and 10% down programs. The 90731 of San Pedro is below 20%. And so you can see I didn't pull all the data of our more affordable cities, but you can expect more of those affordable cities to be below 20% and some of them pushing 10% because those affordable areas, people just don't have the deep pockets of cash, investment, business sales, retirement savings to put that much money down. They are starter homes. They are people working hard to get into their first home, grow their business, and maybe one day buy by the beach or Palos Verdes. So I want you guys to keep that in the back of your head. We've seen price depreciation in Austin, Tennessee, Florida, other areas of Texas, et cetera, et cetera. The South Bay, even though it is completely unaffordable, even though California is the second worst time for affordability outside of the bubble bursting and the Great Recession, our markets have hung in there because we have really high net worth borrowers with many markets at 30% to almost 50% being cash buyers and markets with large down payments as an average for purchasing. So that is why our markets, when you hear our last quarterly report from the previous podcast, that is how we are enduring some of these downswings nationally. That's why prices haven't fallen amid horrible affordability. And so if our markets can remain resilient thanks to these cash buyers who are relatively unaffected by interest rates, imagine how good this is for our marketplace if interest rates come down by a percentage point or a percentage and a half, and those people who are putting 20, 30, 40, 50% down and how much more they can buy with lower interest rates, or buyers who couldn't afford, who can now afford with X amount down along the beach and Palos Verdes. So this is really powerful data. If you want to really dial into the numbers, please go to my blog, haynesre.com/blog. You can look at what we talked about today in deeper numbers. I have the affordability numbers listed for our beach and Palos Verdes cities. I have an intro into cash buyers and really detailed numbers on the total sales, percentage down, and cash buyer. And then, of course, I talk about falling interest rates and how that is a great thing for our local market. So you guys, to put a bow on everything, watch interest rates. We do expect the Fed to cut rates by a quarter of a point. It's not out of the realm of possibility for them to cut by 0.5%. It doesn't mean that rates are going to go down when they cut. They probably already have. But if we continue to cut, if inflation continues to come down and the job market slowly erodes like we've seen in a couple reports, we could see significantly lower rates in the 5% range or lower for jumbo loans with some credit unions. So keep that in mind. Number two, affordability is still horrible here in the South Bay, but cash buyers and high down payment, high net worth buyers are keeping the market afloat amid low supply, We're higher than we were during COVID, but still lower historically. And then last but not least, we have been resilient, you guys. Thank you, cash buyers. Thank you, down payment buyers, and root for those lower interest rates. So I'm going to leave it at that, you guys. Thank you for joining us here again on another edition of the Richard Haynes Real Estate Show. We're going to continue pumping out podcasts for you to end 2025 here. Take care, happy fall, and hope your football team is winning. Take care.